So let's review what we just learned. There are 5 types of accounts in various business transactions. Anytime there's a transaction, the transaction will impact one of these 5 business accounts. If you make a sale and receive cash, then your asset will go up because cash is one of the assets. And if you made the sale, then revenue will also go up. And as you could see, the highlighted ones, assets and expenses, they are normal on the debit side. Meaning, when we debit these 2 types of accounts, their balance will go up. And if we credit those 2 accounts, the balance will go down. The exact opposite is true for those 3 accounts in the middle. Liabilities, equities, revenues. These accounts are normal on the credit side. So if we want to increase balance on those 3, we credit them. And if we want to decrease the balance, we debit them. Okay, let's go back to our debit and credit rules. So take a look at this. So if we say we paid prepaid expenses $1,000 with cash, we could put it in a journal format like this. We debit prepaid expenses to notate our prepaid expense account balance went up by $1,000. And since we paid the expenses with cash balance went down by $1,000. So we credit that account, cash. Since both of these accounts belong to asset accounts, their normal side is always debit side. So whenever we put it on debit side, that means the balance went up. And when we put it in the credit side, its balance went down. So if you would like to say something else, for example, what if you paid cash for inventory? By putting it like this, we debit $1,000 inventory. That means our company's inventory balance went up by $1,000. Let's take a look at liability accounts. Liability accounts are normal on the credit side. It's the exact opposite of the asset accounts. So when we want to increase liability accounts, we credit them. If we want to decrease the account balance, we debit them. Liability accounts include accounts payable, notes payable, interest payable, salary payable, employment tax payable. You could see the pattern here. Whenever you see something payable, you could be very sure that it is type of a liability account. Also, there's a special liability account called unearned revenue. That means when you receive cash from your customer for something that you haven't delivered yet. For example, newspaper subscription will be a very good example. Or maybe I'm a CPA and I may receive a deposit or retaining fee from my client for a service I haven't been delivered yet, but I ask them to pay me first for some whatever reason. Then in that case, I do have received cash. However, it wasn't due to revenue, but it was due to unearned revenue. So instead of increasing my sales or fees account, I increase unearned revenue, which is a type of liability account. Let's take a look at how we could use liability account in a format of debit and credit journal entry. So earlier we talked about that we could purchase inventory using cash. But sometimes you could purchase something without paying cash right away, but we say we will pay you later, and we call that uncredit terms. And when that happens, we call that an accounts payable account. That means I am promising my supplier that I will pay that person later at later time when the due date comes. So in that case, because we purchased inventory and inventory belongs to asset account, we debit inventory to increase the balance of inventory. At the same time, I increase my liability account, which in this case is accounts payable. So I increase accounts payable by crediting it because accounts payable is type of liability and liability's normal side is credit side. Okay, let's take a look at the other remaining accounts. First of all, equity account. Its normal side is credit side, meaning when we want to increase equity account balance, we credit that account and debit that account in order to notate its balance went down. Equity account includes owner's capital, meaning when an individual starts a business, he or her puts his own money into the business so that the business could have a working capital. Now, when that happens, that fund is not owner's money anymore. Once he invests that money into a business, the business now has that money. So from the perspective of business, from the business perspective, owner's capital went up and the business's cash balance went up. In that case, we would increase owner's capital and at the same time increase balance of the cash. That belongs to business. When the owner decides to take that money out from the business, we call that owner's withdrawal. When the owner withdraws the fund that he initially put in his business, then that particular account we call owner's withdrawal account is the exact opposite as the equity account, meaning it follows the other way around. Its normal side is debit, and we debit in order to increase owner's withdrawal account. And we call that kind of account contra account. When we say owner's withdrawal account went up, it's exact opposite of its owner's capital account. So when the owner capital account goes up, for example, when a owner puts $100,000 into a business, then owner's capital will go up by $100,000, and we will increase that account by crediting it because it belongs to equity account. But then later, the owner decides to take out $40,000 out of $100,000 initial investment. When he does that, then we will increase by debiting it to the owner's withdrawal account. But this account is contra account. So what would happen is on our book, it will show owner's capital account 100,000 credit side, and then owner's withdrawal account will show debit side 40,000. So 100,000 minus 40,000 would make 60,000 remaining credit balance on the owner's capital account. Now the retained earning, what it is it just means income for corporations. So don't worry about that for now, but we will talk about that at a later time. Now the revenue account includes fees, income, or sales. Now we are all familiar with what sales mean. That means if you are selling some kind of merchandise to a customer, then when we make that sale, we call that sales, and we increase sales. Sales is type of revenue account, so it follows its normal side is credit side. So we increase credit to increase the balance, we credit the account. Fees income is same concept, only except that it's for the service provided for clients. So for example, I am a CPA, and if I provide services for my clients, I would increase fees income instead of sales, because I didn't really sell anything, but I provided service. So fees income is type of revenue, only except that it's for providing services. Finally, expense account is normal on the debit side, and so it increases when we debit that account and decreases when we credit the account. Expense account is easy to identify because we will see it as something expenses. So that means that we could tell easily that's an expense account. Rent expenses, utility expenses, salary expenses, or tax expenses, there are all type of expenses. So this chart really summarizes everything that we have learned. If you could memorize this, that would be great. And this is really the basic foundation of all accounting journal entry. So please be advised, whether you are using accounting software or whether you are maintaining your books and records by hand at your company. I know nowadays a lot of companies use accounting software such as QuickBooks, but either way, these principles of accounting, debits and credits, rules of debits and credits do not disappear. They are the foundation and basic rules of all accounting software and all CPAs doing their jobs. So if you know these debits and credit rules, you will enhance your job skill and be able to become a more valuable bookkeeper.